Right, let's start the session today. We are meeting a bit of early morning, 7 o'clock, uh, and we didn't meet last week. And I think I already informed you in the previous week, and we are continuing from the previous week's slide set. Now, before I move forward, I think during last uh, 2 weeks' time, within that period, uh, the central bank announced its latest monetary policy stance. Anyone got any chance to look at what really has happened from the central bank perspective? Monetary policy, were there any changes for policy rates and other monetary policy instruments? Any response? What has happened? Whether the central bank has changed the interest rates or not? Recently, there was a monetary policy announcement. I think I mentioned to you that you have to keep tracking on the central bank policy announcements, because each and every policy announcement there could be a change, and that will affect for your exam, because there will be questions on the monetary policy instruments and the level of rates, so you have to know them. So please go and look at what is the change that the central bank has introduced recently in the monetary policy front, right? So that is really important. Take a look on the monetary policy press release. It's not that difficult. It's available on the website. Uh, it's common information or public information. You can basically get some idea about it, right? So please do it. Monetary policy review. Now today we'll move to the last part of discussion, and with this I think we will be completing all these financial markets and the instruments part, and I think we will have a very good understanding if you attempt to some questions as well following this discussion. I think I remember mm, we stopped somewhere around derivatives. Yes, here. Now we need to discuss derivatives. This is the last part of this discussion. So what is a derivative? The word, the term itself indicates a derivative is a kind of a derived financial product. It's not direct instrument. It is based on or derived based on another instrument, which means there is some underlying asset for a financial uh, derivative. So in that sense, we can say a financial derivative is a contract entered into delivering of an asset. That asset could be a currency or a commodity or any other financial product in a future date at a price or valued agreed at the time of the contract. So in a financial derivative, what you do is you essentially enter into a contract today to execute that transaction in the future at the price agreed today. So the profit or the value agreed at the time of the contract and the the realization of this profit is dependent on the market movements. In other words, the profit or the value of the contract depends on the market price of the underlying instrument. Why do you basically consider these financial derivatives? People use this instrument to minimize risk. Now, from our risk analysis, we have seen there are various types of risk arising from the market movements. Remember, we talk about these price variations, interest variations, exchange rate variations, asset price variations. All these lead to changes in the market prices and as a result, market risk. Why do people enter into these contracts? Then you have some assurance on the price or the value. So in that sense, for the risk management purposes, people enter into these derivatives, which means it's a kind of an hedging against some protection against financial losses that could arise due to uh, price variations. And also people might do some arbitrage using derivatives. Arbitrage means you purchase in one market at a certain price and buy or sell, or you purchase or sell in a one market at a particular price, and you purchase or sell in another market at a particular price. So basically transacting in two markets. Why this happens? Because then you can earn some profit out of that. So for that matter also, people enter into financial derivatives. And these derivatives can be traded. Now, you buy a derivative or you enter into a derivative contract, you can trade it. And there are derivative exchanges also in the world. In Western countries, in advanced countries, there is a very developed market for derivatives. So in this market, derivatives are traded. Okay. Now, what are these derivatives? There are various types of derivatives, namely forward contracts, futures, swaps, options. These are the broad categories of derivatives. I think those are the four key categories of derivatives: futures, forwards, options, and swaps. There are some other derivatives as well, but these are the main type of derivatives. Okay? And various parties like dealers, fund managers, financial investors, corporates, which means companies, they use these derivatives for the purposes I mentioned earlier, right? To basically minimize any losses arising due to price variations and also for arbitrage purposes. Now let's look at these derivatives in a detailed manner. Detail in the sense I'm just introducing these derivatives. We are not going to discuss how these are, how these work in financial markets, how these are priced. The operational part we are not going to discuss because that is beyond our purview. We are just introducing these instruments because in your exam you only need to have some basic understanding about these instruments, some definitions and how they are used for certain purposes. That is what we need to answer in the exams. The first category, as I mentioned, forward contracts. A forward contract is a contract agreed between two parties. So, which means there should be two parties, let's say party A and B. to buy or sell, right? To buy or sell a financial asset at a future date at the price agreed today in the contract. So it's an agreement to buy or sell an asset at a certain price at the time of the entering into the contract. So you enter into the contract today, and the price would be the agreed price would be today's price. So accordingly, at the maturity date, the delivery means settlement, right? Settlement will happen at the price agreed today, irrespective of the market prices uh, prevailing at that time. Now, let's say you enter into a contract today at the price of 100, and in 3 months' time, your prices of this financial asset, the contracted item, has changed from 100 to 105. But still, you trade the financial asset at 100 because you have contracted it. Okay. So, what is the purpose of this? You are basically ignoring or discarding the price change. It could be other way around also. The price could be 95. So depending on the price movement, there could be loss or profit in the market if you trade it in the market. But irrespective of that market price, you have some guaranteed price today. You will not have any impact due to price change. Forward contracts are basically traded in the over the counter market. I hope you remember over the counter market. We call it OTC market, where a large number of buyers and sellers trade in this market through communication media, and it's a very large decentralized market, over the counter market, right? And I also gave you an example, the best over the counter market. The example is the foreign exchange market, right? So foreign exchange market is very active on the over the counter market, and as a result, these forward contracts can be largely seen in the foreign exchange market, right? So in the foreign exchange market, we can see this very in a wider way or a popular way. Why? You can hedge foreign currency risk out of this contract. Now let's say you enter into foreign exchange agreement today 200. Let's say you are importing a vehicle from Japan. You have agreed the yen price at a certain level. You assume the future price could be this much, and you calculate based on the current prices, and you enter into the agreement. Of course, when you enter into the agreement, there could be some calculations, some premiums added. All these things will happen, but you enter into the agree into the price today, right? So even the yen price changes in 3 months' time, still you do the transaction for today's agreed price. So if you are if you are importing a vehicle from Japan, for example, then even the yen price would change. You will not have to pay extra or less because of the agreement that you entered into today. And this is very helpful for people who are importing, uh, people who are basically selling financial asset. It's very important. Now, even this could be used in a domestic setup. For example, you can use this for agriculture products. For paddy, you can have a forward agreement contract. Actually, in Sri Lanka, there was a program in the past, forward contracts for these paddy prices. We know paddy prices are very volatile, and most of the time, farmers and also uh, consumers get affected. And government introduced this forward contract mechanism in the past, which means farmer may enter into the contract to sell his future harvest to the trader at the agreed price. So that would reduce the risk of market price changes. So in other words, market risk. Okay? I hope it's clear. Now, this is a contract, financial contract. You have to honor it. You cannot default. Default in the sense, in the future, you have to settle it. You have to deliver it. Failing which, that will be subject to legal mechanism. So, dispute resolution actions. There are, I think, for international in contracts, there are some resolution institutions, boards, Berunಕಾರ Mandala කියලා අපි කියනවා. They act to resolve if there are failures of these contracts. So willful defaults of these contracts, that mechanism is also there. So that is forward contract. Next category is futures contract. These are also very similar to the forward contract. Exactly similar. If you look at the definition, it is very similar to the first one. An agreement between two parties to buy or sell an asset at a certain price at in the asset at a certain price agreed at today. But only difference of a futures contract, they are standardized contracts. Standardized means they are traded in exchanges. They are traded in exchanges. Now, forward contract is over the counter. Futures contracts are in exchanges. I told you, there are some derivative exchanges. So these forward contracts are basically set up and traded in the exchanges. So they are standardized. What are these standards in the contract? In terms of volume, maturity, delivery period, the pricing mechanism, all these are basically set up in a way that can be used the product in an exchange. So best example for these futures in the market is oil market. In the oil market, there are oil futures. For example, if you want to import Brent oil at a specified quantity, right, you can enter into a futures contract for 3 months, and the price is decided between the buyer and the seller in the trading system at the exchange. So what you agree the price today will be a kind of a price agreed at the exchange, determined at the exchange. Okay. So as I said, they are very similar to forward contracts. Only difference is they are traded in exchanges. Then we have options. Options. Now options by name, there is some flexibility option for the parties. So we can define options as financial contracts which give the right to buy or sell a fixed quantity of a financial asset. It could be a commodity, currency, or whatever. Okay, at a future date, at a price agreed in the contract at the present. Now, in these case also, you enter into the contract today. You enter into the contract and consider the price today. But with compared to forwards and futures, in this instrument, the parties have some right to buy or sell the asset. It's a kind of a legal right. So there are two types of options as a result: call option and put option. Right? Call option and put option. Call option gives the right the holder to buy the underlying asset by a certain date for a certain price under this call option. So the holder of the call option, he has the ability to buy this asset at a certain date at a certain price. So the price we use for this matter is referred to as exercise price. Exercise price. In other words, this is the contracted price, exercise price. Some people, they call it as strike price. Why you call it strike? That is the price that the transaction will happen. Okay. The date in the contract is known as the expiration date or the maturity. And similar to call options, you have the put options where the holder has the right to sell the underlying asset by a certain date at a certain price. So that if you see these terms, call means you always have the ability to buy. If you have put, there you have the ability to sell. Call always refer to buy, put always refer to sell. Okay. So these two types of transactions happen in the market depending on the, now all these are happening due to the preferences and forecast of the financial market. Now you don't know about the future, no? You cannot I mean, you don't know exactly. You can only do some forecast predictions, and by considering those predictions and forecasts, you enter into this transaction. You can go wrong, but still you are trying to minimize any loss due to this future transaction by entering these by entering into these contracts. And there are some other classifications also: American options, European options. Likewise, we are not going to discuss in that detail. But if you see these terms, American options or European options, those are some conventions or some methodologies applied by the financial markets when they are trading in these markets. Okay, so this is the second type. And similar to options, I also included these warrants. I didn't mention it as a major category. It's a kind of an extension of options, right? I included this thing because in one of your exam papers, this question was there. What are the warrants, right? It is also a kind of an option. A warrant is a derivative that confers the right. There is a right to the holder to buy or sell a security. Right? Now, what are the differences or some major features of a warrant? Warrants are basically applying to equity market. Right? Now, these options could be anything: currency, commodity, financial product, or any similar product. But warrants, mainly we can observe warrants in equity markets. Okay. Now here also, since you have the option to buy or sell, which means you can call it as a call warrant or a put warrant, and the price we refer it to as the strike price. The maturity is there. So all these are very similar to an option. So the major difference come from, as I said, they are using in equity markets. But other than that, in general, the major difference of warrants and options come from how they originate and based on the maturity. Now, usually we see stock options are listed on exchanges, right? But warrants are mainly issued by the company. So there is a key difference. So if you take option and warrants, options are mainly into exchanges. Warrants are mainly issued by the company, right? So that is one difference. And also warrants are mainly for long-term period. Normally these contracts have some long-term maturity. But options, usually you observe it for short term, 1 month, 3 month, likewise. Right? So the way it works is very similar to option. So in that sense, both warrants are options very similar, since you have the right to buy or sell a financial asset, but major difference come from whether it is issued by a company or the exchange itself. Then the last major category is swaps. I think this word swaps is very common and popular in the financial markets. Swaps are financial contracts entered into for the purpose of covering risk by having a contract in opposite to the underlying trading contract. Now here, what you have is you are trying to cover the risk of a contract or a financial transaction by having an opposite contract to the asset. In other words, you are basically exchanging two financial products here. Swaps are the exchanges of two products. The term swap indicates, swap means when you are saying swapping, you are exchanging. You are giving something and you are getting something. Swapping. And there are different types of swaps in the market: currency swaps, interest rate swaps, credit default swaps. Those are the major or very common swaps that we observe. Okay. Mostly we observe currency swaps in the markets, especially banks, governments use these currency swaps. What happens in a currency swap? A currency swap is a contract to buy foreign currency while having an opposite contract to sell the same foreign currency in the same quantity to another party. An agreement between two parties to exchange the principal amount of a loan or interest of one currency for the principal and loan interest in another currency. Let me tell you an example. Let's say a commercial bank borrows from abroad. He takes a loan from abroad, let's say in dollars, right? He takes this loan, let's say $10,000, a very simple amount, a loan. Now, when he receives this loan from the international counterparty, he gets dollars. Now, someday he has to pay back this dollar amount. And when he is paying, there could be large variations in currency value. Currency could be depreciated or appreciated. So, depending on the commercial bank, might have some currency risk, currency loss, profit could be there. So, to minimize it, the commercial bank gives this currency to the central bank. 10,000 he gives to the central bank and he takes rupees for that, equivalent to this 10,000. Why? This commercial bank, they might need rupees to lend to their domestic transactions, to buy treasury securities or whatever. They need rupees. So when they need rupees, they get it from the central bank by swapping these $10,000 amount. When they are swapping it, they enter into the contract of the swap contract. So there you agree with the exchange rate. So in the future, this transaction will be reversed and the 10,000 will be given to the commercial bank again. And the exchange rate will be basically the agreed exchange rate on that date. So what will happen? The exchange loss or the any variations of the exchange have been minimized by the commercial bank by swapping with the central bank. Now, of course, to do this, you have to pay some extra margin also that you call as swap points, right? These swaps do not happen, for free. There is some margin for that charged by the swap points, which means some small interest. So some swaps are there like zero cost swaps where you don't pay any interest swap points, but usually that involves some swap points as well. Okay, so this is the most simple way that I can explain a swap, currency swap. And in reality, in operation, this is a very complex product. You need to know how to value it, how to transact it, how to settle it, the maturity. There is a comprehensive process. We are not going to the details, but simply keep that in mind. You can basically borrow in one currency and swap it with some other party for a different currency to minimize the currency risk. Now, during this period, now let's say this is a 3 month swap. During this period, two parties they are free to use that currency for their trading or investment purposes. So it is not basically fixed or deposited. You can use it, but only thing at the maturity you have to return the amounts that you have agreed. Now, these are very common. I think, as I said, the commercial banks use it, and even the governments use this. Now, hope you have seen in recent news, the central bank has taken currencies of facilities from China, from Bangladesh Bank. What does that mean? The central bank has taken some yuan loans or Bangladesh dollar loans, that is in dollar, and use that money by crediting rupees to their account. So they are getting some interest and earning from rupees. And at the maturity of the swap, you convert into the dollar or yuan and you pay back. Right? So these are used by the central banks for their smooth operations because, as you are aware, these days we are lack of foreign currency, and the central bank is using such mechanisms to have some funds for a period. Okay, and the second type is interest swaps. There you involve exchanging a fixed interest rate for a floating rate. Why? To reduce the exposure to the fluctuations in interest rates. Now, in the previous currency swaps, you are mitigating the exchange rate risk. In an interest rate, you are mitigating the interest rate risk. Now, for why it is needed? Now, for example, let's say you take a loan at a fixed rate. When you take a loan at a fixed rate, there is a risk that if the interest rates go up in the future, you are better off because your rate is fixed. But interest rates goes down in the future, then you make a loss. To minimize that, you borrow at fixed. Maybe you can lend money at a floating rate with some other party. So again, you are doing some swapping of money with the fixed interest rate and the floating interest rate to minimize the loss of due to interest rate variations. Okay. So by allowing interest rate to change from one end and fixing interest rate from the other end, it's like an interest rate swap. These interest rate swaps are very common in advanced markets. We can see most of the swaps instruments there are basically based on this interest rate swaps concept. Now I told you there is a third type of swaps, credit default swaps. Now, what is the idea of credit default swaps? We call it CDS. They became very popular during financial crisis. These are designed to transfer the credit exposure of fixed income securities between two parties. Fixed income securities means bonds, right? So when you have a bond, the bond prices change. Remember, due to interest rate changes or any default, there is a risk of a bond. Now, that risk is not there if it is a government bond. But what we are talking here is this is credit default swaps are mainly applicable for corporate bonds. Usually, or very rarely, governments default. No, usually they don't default. But corporate bonds, which means private bonds, there is a possibility that default could happen. So these credit default swaps are a form of insurance given to the investors uh, who are worrying whether the company that they have purchased bonds will be able to pay off the bond or not. So this is a kind of an insurance for the bondholder. Now, if you look at this small picture, you will understand this. Now, let's say this 123 firm, this is a company, they are buying bonds from ABC International Company. So, this is an investor, this is an issuer, right? They issue bonds to investor. ABC issues bonds to 123 firm. Now, this 123 firm is worried. What is the worry? They think whether this company ABC will be able to pay off their bonds at the maturity. And as a result, if you have that uncertainty, there could be deep discounts or price, disadvantages of these bonds if there is such uncertainty. To minimize that, you can ask for an insurance, some protection. So what happens, this ABC company insures their bond for this 123 firm. 123 means basically the investor. No? They insure with this 456 bank. What is the insurance? They agree if this ABC fails to pay, bank 456 will pay to the investor if there is any default. Right? So there is some security for the bond. You don't mind if the company fails. You know the bank would pay for you. So that is called as credit default swaps. You are swapping your risk with another party. Your default risk is swapped with another party. That is the idea. Now, why does this bank 456 do this thing? They will get a charge for that fee. So they also earn income by this arrangement. Okay. So these are very common and was very actively used during very closer to the period of financial crisis. Okay. Now, related to this, there are some other instruments also used in financial markets. We call them as structured financial products. Structured finance. Why this structured finance is there? These are basically applicable for the loans given to certain borrowers by financial institutions, and through these structured products, what they are doing is they are transferring the risk to someone else. Now, let's say you have given a loan to party A, you have some risk, right? If this loan is kept in your balance sheet, you might be having some risk. In a structured product, what you will do, rather than keeping it with you, you give it to someone else. Let's say party B, in the form of a securitization. You call this, or you refer to this method as securitization. What do you securitize? You securitize the credit risk of this loan. Such instruments are referred to as structured products. By structuring, you are removing certain assets from your balance sheet and you clean the balance sheet. Now, usually people do this when this borrower is a subprime borrower, or there is some risk that he will not pay, right? So if there's a risk that the borrower would not pay, what you do is essentially you transfer that asset to this securitization mechanism. So there are some examples like CDOs, collateralized debt obligations. It's a structured product. Asset-backed securities, it's a structured product. So in a collateralized debt obligation, there a securitized firm is there in the case of a default. In asset-backed security, there is a kind of a firm as a securitization firm in the case of a default. So here we introduce or explain this securitization process, how it happens. So securitization, very simply, you are taking an illiquid asset or some risky asset from your balance sheet and you transfer them into a kind of a security. You create another security. Securitization means you are creating some other security, and that new security will be traded or sold to some other uh, investors, right? Now in this diagram you will understand this process. Now let's say similar to this is A, no? Similar to this, you have given loans to A, B, C for project 1, project 2, project 3. There are 3 projects. And out of these 3 projects, you create your portfolio, right? This is your loan portfolio. Let's assume these are some subprime borrowers, less creditworthy borrowers, A, B, C. Out of this, you have this portfolio for their loans. Now, let's say you have some risk of receiving these loans back. What you can do, you convert into a different asset now through securitization process. This part is called as securitization. What do you do as a securitization? You create some new instruments, share 1, share 2, share 3. Likewise, the entire portfolio you now convert into shares and sell it back to some other investors, investor 1, 2, 3. Likewise, there are various investors. Now you might think, who are the people who buy these risky assets? Don't think that way, because in the market there are some people who want to have some risky assets, because for these risky assets the return is high. So there are people who are seeking high returns. They might be purchasing these. Okay. So through this securitization process, you are able to create new assets for your risky assets and sell it back to the investors. This process is referred to as securitization. Now again, this process is very complex process, right? There are special entities created for this uh, uh, process. Now, this part securitization usually done with an SPV. SPV means special purpose vehicle. It's a separate entity, separate company, right? That's what I'm saying. Those are, some complex things, but at least you should have some basic idea what is securitization. The process of taking illiquid or risky assets from your balance sheet, from your entity, and transforming them into a new instrument. So I told you here we have some examples: asset-backed securities, collateralized debt obligations. These asset-backed securities and CDOs, they are operating in the same way. Why? They are created through the securitization process. So these securitization process, here you sell these CDS, CDOs or ABS, right? How these have been created? Based on these loans. Loans for housing, loans for automobile, loans for factories. Using them, you create these. That's why I say ABS are bonds collateralized by mortgages, loans, or other receivables. So here, instead of shares, what you create is a bond. Here also, it's a collateralized debt obligation is a bond, right? These are created for the purpose of eliminating risky assets from the balance sheet. Right? These contingent convertibles are also used in now these things especially used in global financial crisis during that period to minimize the risk, right? These contingent convertibles are also used in a crisis period, mainly uh, if there is a failure of a bank, right? These are used to reduce the debt and to capitalize the bank. Now, in a crisis, what will happen? Capital of a bank will go down because in the crisis, when you have losses coming from what? When borrowers do not pay back, you have some losses. So those losses are absorbed by the capital. So capital goes down. So in a crisis, that's natural, capital goes down. Now we know a bank has a certain threshold of capital. Let's say 10% risky assets. Out of that, you have to have capital. Assume your capital goes down below this 10% and reaches 5%. So now the bank is at a huge risk. It could even collapse. These contingent convertibles, COCOs, are issued to enhance this capital. So banks can issue these to top up capital in a crisis. So it's a kind of a capital boosting instrument of a bank when the bank is hit by a capital loss and reduction in capital. So in the financial market, it appears as a hybrid instrument. Hybrid means it's like an equity, it's like a bond. Both features are there. Contingent convertibles. So have some idea. This again I have seen in one of your papers in the past, not in many instances. In one or two papers, one paper I have seen this question, contingent convertibles. Okay. So those are the key instruments that we can understand, we can identify in the financial markets in modern context. Some are traded widely, some are very popular, some are not that popular, but depending on the circumstances, depending on the needs, these are used in uh, various markets. Okay. Now let's look at some examples for financial instruments in Sri Lanka, especially this is an annex. I just wanted, I think I told you, I will give you a brief understanding about the uh, bonds used in Sri Lanka, government bonds. There are various types of bonds used in Sri Lanka. Some discussion would be helpful. Now, the main government instrument in Sri Lanka, treasury bills. Right? Now, this treasury bills, as you know, it's a short-term instruments. Only maturity, maximum maturity is 1 year. So there are three type of maturities: 3 month, 6 month, 1 year, and these are considered as money market instrument. Why do you have to have money market instruments? For cash flow needs. Cash flow means you have to have money, liquidity every time. Because of this cash flow management, the fulfill of shortages in the uh, daily cash management, the government issues treasury bills. Every week there is a treasury bill auction. So for a year there are 52 auctions for treasury bills because that is helping to manage day-to-day cash needs. These are issued in LKR rupees, auction basis. Auction means there's a competitive bidding process. Who can buy these treasury bills? Only the primary dealers, right? At the primary auction. They go to the secondary market and sell to other people like you and me. We can't buy from the central bank. Only primary dealers can buy. They are selling that in the secondary market, so we can buy. Who can buy? Sri Lankan citizens mainly, but recently in the sense I think some 10, 12 years ago, the government opened this for foreigners. Now the foreigners can buy up to 5% of this treasury bill total amount. Okay. Foreigners means could be foreign entities, foreign people, expats, right? And I told you treasury bills are issued at a discount. Discount means if the bill is 1,000, they issue at 950, for example. So your return 50, you get it upfront. You get it upfront, right? So at the maturity, you get it. Uh, for example, you buy 950. At the maturity, your value is 1,000. So which means without there is no capital gain, no loss as such. Since it is issued at the discount, you already have your return in your hand. Other things I'm not going to discuss. These are some, some features of this market, but interest rate is market determined. Market determined means basically since primary dealers are coming and bidding, the yields are determined in the market. Then we have treasury bonds. Treasury bonds are long-term instruments, as you are aware. Long-term instruments are issued for mainly for investment purposes, for formation of capital, right? The government can have money for a longer period. There are two types of bond: conventional bonds and inflation linked bonds. Inflation linked bond means here the interest rate is attached to inflation rate, let's say CCPI. Nowadays we don't issue these bonds, but in Sri Lanka we have these. Normally conventional means traditional bonds 2 to 30 years is a longer bond, longer period, issued in LKR, auction basis, primary dealers, Sri Lankan citizens can buy, and also foreigners can buy up to 5%, right? And in a bond you get coupons. Remember, in a bond you have the interest rate as well as coupon rate. So as a result, these bonds could be sold at a par value, at discount, at premium. That is dependent on the interest rate. Okay. Now in Sri Lanka, the volume of bonds is much bigger, because this is helpful to mobilize money for a longer period for the government. Then we have rupee.
Excuse me, sir.
Yes.
The bonds also can buy in the secondary market, isn't it?
Exactly.
Normal people? Okay, sir. Thank you.
Exactly. Good question. Yes. Primary dealers can buy from the central bank. They can sell these bonds in the secondary market to anyone. Even you and me can go and buy from the secondary market. And there are rupee loans. Rupee loans actually now it's not issued in Sri Lanka anymore, but still we have some balances. These are some long-term instrument issued by the government for 2 to 30 years, because these bonds have been introduced in 1997. So before that, the long-term instrument we had was rupee loans issued in LKR for Sri Lankan citizens. But only thing, this rupee loan is not a marketable instrument. There's no secondary market. You simply buy from the central bank or from the primary dealers, and the interest rate is administratively determined. The central bank or the government will tell you this is the interest rate. Okay, not a marketable instrument. So as a result, this instrument is not used right now in a popular way. Sri Lanka development bonds. I think I mentioned to you this sometimes back also. These are foreign currency denominated bonds, US dollars mainly, issued for 2 to 3 years, for a relatively shorter period or a kind of a medium term period, auction basis, competitive bidding process. And this is, the interest is determined based on the LIBOR. Interest rate is internationally recognized interest rate. LIBOR plus some margin. LIBOR plus 200 basis points likewise, because you are denominating your bond in dollars. So that's why the LIBOR is applied. Now, these SLDBs are issued for foreigners actually, foreign citizens, non-residents, dual citizens. Authorized dealers means banks, right? Now, normally, these SLDBs are purchased by banks because they have foreign currency, no? Banks are getting foreign currency from outside parties, from remittances, from exports, from tourists. The banks get foreign currency. They invest this foreign currency in the SLDBs, Sri Lanka Development Bonds. Then we have ISBs, International Sovereign Bonds. These are very similar to Euro bonds. Remember, I used the term Euro bonds. Euro bonds means these are traded in, issued and traded in international market. Now, SLDBs, they are issued in Sri Lankan market. Okay? And also there's no secondary market. Issued in Sri Lanka, that's all. ISBs, they are issued in international markets and there is a secondary market also. You can buy and sell this sovereign bond in the international markets. Why these sovereign bonds are issued? The governments want to raise foreign money, dollars, sterling, or whatever. Foreign money can be raised through sovereign bonds, mainly issued in USD. Since this is a bond, it is a bond, there is a coupon, medium to long term maturity. Now, the maximum maturity we have issued in Sri Lanka is 10 years for ISBs. Non-resident investors can buy. Sri Lankans cannot buy, but last year, I think this year, the central bank allowed commercial banks to buy because they have foreign currency. Right? Otherwise, normally it is issued for foreigners. They are traded in international bond exchanges. Our bond is mainly traded in Singapore stock exchange, bond exchange, right? So this chart is from Bloomberg terminal, how one of our bonds trade. So in this table, we have all these outstanding bonds that we have, right? Issue dates are given here. Right? Altogether, we have issued up to now the outstanding value is around $14 billion. It's a substantial amount, and some of these bonds are maturing this year, next year, right? These are the issued amounts. So the maximum amount we have issued is 1.5 billion at a time. Okay. Any questions up to this point? Anything to be clarified? Okay. Shall we take some exam questions? Are you there?
Yes, sir.
Okay. I am having this latest paper, January 2021 paper. These questions are not in the slide set. Okay. So I'll just read some of the questions for your benefit. Then you can take a note if you want, or if you have the paper with you, you can just turn the paper. So question 1. In this question, I think there are some multiple choice questions. Let's see whether we can answer these easily. Which of the following is the most appropriate example for the co-function of an efficient capital market? There are 4 functions given. Which one is the most appropriate co-function? Answer A. Pooling of savings and mobilizing of deposits for productive investments. Answer B. Developing an active corporate bond market. Answer C. Developing a risk management framework for the financial system. Answer D. Developing IT infrastructure for the stock exchange. What do you think? Let me go to the chat. Then I think I can see if you have answered. Achala has said we have to start from
B, sir.
sorry.
Answer is B, co-function of an efficient capital market developing an active bond market.
Yes, yes. Correct. Thank you, Achala, reminding we have to start it from the warrants part. Yes, true. I think I repeated the first two because last time I think I rushed that derivatives first part. So that's why I repeated. Thank you, Lakshani. Sukhilini, your answer is correct. Is that you, right?
Yes,
Answer
sir.
B. Answer B. Yes, correct. Next one. List. This is question B2. B actually question 7 of 1. Question 1.7. List 2 foreign currency debt instrument issued by the government of Sri Lanka.
Sri Lankan Development Bond and International Salvation Bond.
Yes. Sri Lanka development bonds, international sovereign bonds. Those are the only two. We have not issued panda bonds or samurai bonds. I remember I was discussing. We were considering to issue, but we have not issued up to now. Only Sri Lanka development bonds and international sovereign bonds have been issued. Next question. Name one index each used in domestic stock market and major foreign stock markets. We know there are stock indices, no? So we need to understand or we need to name some of these indices. Can you name indices for the domestic stock market?
All share index market.
All
Sorry,
share,
all share index.
yes, ASPI.
Another other one is
Yes.
S&P SL20 index, Divi Savi index.
Yeah, we have S&P SL20 index. Remember these definitions? ASPI reflecting the entire market behavior, isn't it? Remember, it captures all stocks listed in the stock market. Then we have S&P SL20 index where we capture all liquid and largest company stocks. And then we have Dirisavi index. I didn't discuss that in the class, but Dirisavi index used for SMEs, right? There is a board for SME type of companies. So their performance is reflected by the Dirisavi index. What are the international indices? Now, can I suggest you, why don't you go to the stock market website and, just surf? I'm just, I don't need to teach in the class, and also I don't need to advise you. But depending on the discussions, why don't you search on Google and, relevant entities or website to get some, additional understanding? Please do that. Even you can search the central bank, Ministry of Finance, stock exchange, right? There are stock brokers. A lot of information is there. Can you name few international indices? I think I mentioned to you Dow Jones, S&P 500, Nasdaq, All these are American or US stock exchanges, stock indicators. Nikkei, Japanese major index. Shanghai is a Chinese stock market index. Sensex, I think it's Bombay Stock Exchange. Likewise, there are various international indices. Next question. Name the derivative product that facilitates the simultaneous exchange of two different currencies between two parties at an agreed exchange rate for an agreed period. You can get
FX swaps.
FX swaps, very easy. Currency swaps. I'm just looking for some other questions in. Right. Here we have an interesting question. Question 4.2. A buyer of corporate bonds wants to eliminate possible losses arising from default by the issuer of the bond. A buyer of a corporate bond wants to eliminate a possible losses arising from the default by the issuer of the bond. Now, for this purpose, you have to advise the buyer what he can do for this purpose. He wants to eliminate the risk of the corporate bond default. What can you suggest for him? Which type of financial product that he should be looking for?
CDS.
He can use a CDS, which means a credit default swap. We know that CDS is a kind of a derivative product allowing an investor to swap the credit risk with some other insurance company. Remember that example? 1, 2, 3 investor buying a bond from ABC company, insuring that with 4, 5, 6 company. Remember bank. The same example applies here. It's like an insurance policy against the possible risk. Now, can you advise this investor also? An individual who wants to invest in shares and expects a fixed return. What is the instrument that he should buy?
Treasury bonds.
He wants to have a share, not
Oh,
the bond.
sorry, sir. Sorry,
It's
sir.
okay. No, it's okay. He wants to have a share, but he expects a fixed return. Normally in shares, what you have is a dividend, right? You don't get fixed returns of a share. You normally get dividends. But here you expect both dividends and a fixed return. What is the best instrument for him? Remember, I discussed different types of share instruments. For this matter, he is better off if he has a hybrid instrument. Hybrid instruments are preference shares. Preference shares. So preference share is a share issued by a company, a stock, but it also has a fixed dividend. right? So these preference shares, they don't have voting rights. They're like, secondary shareholders. They don't have voting rights. But in the bankruptcy, they get their dues first because it is like a debt instrument since you are getting a coupon as well. That's why I call it a hybrid instrument. I think in the latest paper, we have few more questions. Write short notes on the following. So here we have some questions. Loan protection. We didn't discuss this thing, but I think this is an applicable question because we discussed bank loans. What is a loan protection?
A bank
Insurance,
cash.
Yes, go ahead, please.
just an insurance cover to reduce the risk.
Yeah. So since this is a short note for 5 marks, you have to elaborate it bit. Okay. So you can write like a, kind of a narration. Now, people take loans from the banks, financial institutions for various purposes, right? For housing, mortgages, automobile, or whatever investment purposes. They take loans for personal reasons. But due to some unexpected or unforeseen event, could be an injury, illness, death, disability, or whatever, there could be some instances people may default the loan, repayment of the loan, either interest or the principal. So this creates some risk to the lender, which means some credit risk is there for the lender. So in order to mitigate this credit risk, lender can buy a loan protection. He can have a loan protection, and the loan protection provider payoffs when the loan repayment is not done by the borrower. Now, this is very, I think, common in the case of uh, housing loans, mortgage loans. You have these mechanism, isn't it? Hmm? Now, someone has also suggested this bank assurance, very similar to loan protection, but it's not exactly loan protection. I think this bank assurance also was in your exam paper. What happens in a bank assurance product? In a bank assurance product, there is an arrangement between the bank and the insurance company, right? They have an agreement. What is the agreement? The bank allows insurance company to sell their products directly to the customers, bank customers. Clear? Now in Sri Lanka, I think some banks do this. I remember commercial bank, they are doing this bank assurance. They are allowing a kind of a convenient way to fulfill the insurance requirements of their customers through a designated insurance company. So in that sense, loan protection and bank assurance is not the same. Okay, clear? Thank
Yes,
you.
sir. Thank you.
Thank you for suggesting the answer, but really, I mean, thoughtful. Second one, treasury bonds. How do you give a short note? I think you are aware treasury bond is a instrument issued by the government, right? So you have to elaborate it a bit. Treasury bond are government debt security, and it is a long-term instrument, right? Normally issued for more than 1 year, could be up to 30, 40 years. And the bond involves or includes or it earns periodic interest payments, which means coupons, until the maturity. And at the maturity, the holder of the bond can sell it at par or discount or premium depending on the interest rate movements. And they are risk-free instruments issued by the government, marketable, which means there is a secondary market. It is issued by the government to raise their long-term funds. Yes, 2 to 30 maturity, 30-year maturity, correct. And in Sri Lanka, this is for locals, and foreigners can also buy up to 5%. You can add some Sri Lankan examples also, right? When you give the answer. Auction basis, yes, correct. Third one, common stocks. What do you mean by common stocks? They are generally known as what? Ordinary shares. Why these ordinary shares are important? The holders of these ordinary shares, so common stocks, they are the owners of the company. So they have voting rights. As a result, they can elect board of directors, vote in company matters. What is the earning they get? Ordinary shareholders, what is their earning?
Dividend.
Dividends, yes. They get periodic dividends. In the event of a liquidation, bankruptcy, what happens? Common shareholders.
They are considered as the secured debtors. The priorities given to not given priority. They no sir, not
Yeah,
we are not giving
exactly.
them the priority.
Exactly. They don't get the priority. Priority will be given to debt holders and preference shareholders. These common shareholders will be the residual claimants. Remember, I used the term residual claimants. Okay. And in the balance sheet, their amount is mentioned under equity. Right? This common stock holding is mentioned under equity. And there's another product, I think we discussed this under bank off balance sheets as well. It's a very common product used in international trade. LCs, letter of credit. What is an LC?
It is given by local bank on behalf of importer to foreign currency. Sorry, foreign bank
Yeah.
regarding the trade market.
So it's like a guarantee, right? It's a guarantee. A letter of credit is a letter from the bank guaranteeing that the buyer's payment to the seller will be received on time and in correct amount once the goods have been received, isn't it? What happens if the buyer is unable to make the payment on the purchase?
Bank will make the payment,
Yeah,
and after that they will recover from the importer
they
with the
will recover.
charges.
Yeah, they will recover from the client. So it's a kind of an assurance, a guarantee to ensure that smooth cash flow and the goods flow happen in international trade, isn't it? I think if you take this latest paper, there are very good questions relating to our discussion. Let me also take another few questions from one of the previous papers. I'm having a 2019 March paper with me. Let's take a couple of questions. 1.3. The corporate debt security market in Sri Lanka is regulated by the Central Bank, Colombo Stock Exchange, Securities and Exchange Commission, Lanka Secure. What is the answer?
So please repeat the question again.
The corporate debt security market in Sri Lanka is regulated by the Central Bank, the Stock Exchange, Securities and Exchange Commission, Lanka Secure.
The the stock exchange.
Are you sure? Let's follow the approach of who wants to be the millionaire, right? You can lock in the answer. You can have the helpline, switch, whatever. Are you sure?
Security and Exchange Commission of Sri Lanka.
Exactly. The stock exchange is also regulated by whom? Securities and Exchange Commission. They are the regulator, like the central bank. Okay, now here we have some calculation. If the spot rate, LKR rate is 179, 1 month forward USD LKR is 180. What is the annualized 1 month forward premium?
6.70.
How do you calculate it?
180 minus 179 divided by 179 into 12.1 into 100.
So the principle is you take the difference between the forward price and the spot price. FP minus SP divided by SP. SP means the spot price. In this case, spot price is 179. So that's why you have 180 minus 179 divided by 179. Then you multiply by the time factor, right? Time convention. Now in this case, it's annualized. So since it is annualized, you can simply multiply by 12. If it is quarterly, you multiply by what? 12 divided by 3 means you multiply by 4. Right? Annualized, since this is monthly, you take 12. If it is quarterly, you take 4. Sorry, 3. If you have semi-annual, you take 2 likewise and multiply by 100, 6.70. Which is the regulatory institution regulates the insurance companies in Sri Lanka?
Insurance Commission of Insurance Regulatory Commission of Sri Lanka.
Yes, IRCSL, Insurance Regulatory Commission of Sri Lanka, earlier known as IBSL, Insurance Board of Sri Lanka. Okay, question number 4. Here we have some, products, right? Financial products are there. Briefly explain the financial product and provide one purpose of each that could be fulfilled by these assets or the products. First one, FX forward contract. What is the FX forward contract? How do you define it? How do you explain an FX forward contract? In an FX forward contract, two parties enter into a foreign exchange transaction to exchange foreign currency at an agreed price today at a specific time in the future. Two parties agreed into a contract to exchange foreign currency in a specified future time at an agreed price today. What is the purpose of this FX forward? Why do you enter into this FX forward?
Used as a derivative product, as a risk hedge.
Has the risk hedge. You can hedge the risk, and also even for arbitrage, isn't it? For speculative purposes also you can do. You might think, okay, exchange rate will be depreciating or appreciating. By expecting that, you can enter into this transaction, forwarded contract. Second one, financial lease. What is a lease? So it's a type of a facility in which a company lease out certain assets for the users for a specific period of time. And in a financial lease, we know the legal ownership of the asset during the asset usage will be vested with whom? With the
Finance company.
finance company. We call him as who? Lessor, isn't it? Lessee has the operational control, operating control, and the usage, risk, and maintenance. All these is vested with the lessee, which means the borrower. At the end of the contract, what will happen? Once all rentals have been paid, the ownership will be
Transferred to the lessee.
transferred to the lessee. Until that, absolute ownership is with the company. Why do you need to have a lease? What is the purpose?
If you can't afford the asset at a certain time by paying the some amount in one instance,
Yeah,
you can have a lease facility and pay by rentals.
exactly, Chatura. Thank you. And that is basically helping us to obtain or have capital assets, right? Because you normally use leases for some long-term assets, vehicles, some durables, right? Some machinery, factories, buildings. Third one, General insurance products.
Excuse me, sir. There's no one thing. Usually, there's a context in a lease agreement saying that after completion of the lease facility, after paying all the rentals, asset is selling to the lessee for a certain amount. So, is it just a transfer or the selling the asset to the lessee?
It's actually, I think what happens essentially, it's a kind of a transfer, no? Now he has already paid his dues, which means he has already transferred money for the purchase. So at the end, the ownership is transferred. In a higher purchase, this transfer will not happen. It has to be basically requested. If he has to express that he wants to buy. So it's a kind of a transferring. So in these contracts, you have these wordings, Chatur.
No, actually, even in the commercial banks, most of the banks are charging as a settlement fee, even
Right.
after paying all the rentals.
Right.
No,
Those
actually,
are there.
Yeah, one customer was questioning me that why are you obtaining this fee, something like that. Actually, that's also a question.
They are like, business decisions, no, of the financial institutions. Probably I'll check on that, whether they are charging a settlement fee on that. I'll check with our non-bank department. Why is that?
Okay, thank you.
Thank you, Chitra. Okay, general insurance products, very quickly. These are insurance contracts that do not fall under life insurance covers, right? Different from the life insurance or health insurance, isn't it? And for general insurance, there are different forms like fire, marine, motor, accident, other miscellaneous. Some you can broadly call them as non-life insurance products. Why do you need to have these products? General insurance. To provide some protections against
Losses.
yes, unforeseeable contingencies or losses occurring due to unexpected things. Last one, consumption loan. What is a consumption loan? These loans are given by banks to individuals based on their what? Earning capacity, isn't it? Salary or income particulars. It's like personal loan, right? Consumption loans, you can also call them as personal loans. Consumption means not to basically, day-to-day consumption. It's for a specific purpose, but based on your salary and income particulars. Why these consumption or personal loans are there? What is the purpose? To meet your needs in terms of medical emergency, educational purpose, or even for marriage or settling some debt, whatever, right? These are like some consumption purposes. Right, other than that, I think some of the questions we already covered. In question 7, you have these S&P SL 20 index, which is basically the interest rate, index in the Colombo Stock Exchange to monitor largest and most liquid companies. Land price index, I think I remember when I was discussing central banking, I told you the central bank is compiling and analyzing land price index in order to monitor the developments in the real estate sector in Sri Lanka. So it's a biannual index constructed by the central bank to monitor land prices in the Sri Lankan economy. So likewise, in past papers, you have different questions. I try to attempt those questions as time permits and as you I mean, since you have to do some practice, have some practice before the exam. Okay. Next week we will be starting a new session. I think we are gradually moving to the last part of our discussion, and hopefully we can finish in 2 weeks time, or 2 or maximum 3 weeks time. We will be done, and we are ready for the exam. And I think exam is in January or February. Have you already heard of the exam dates? Not yet, right? I think it's January. January.
They said was that's in January, sir, because they have
January.
scheduled some revision classes also.
Yeah. We'll have some revisions, and after that we'll have the exam. But anyway, you have some good time. Don't waste that time. Use it productively, and do it properly. Spend some additional time, especially trying to answer in the questions papers. Right. Shall we wind up for the day?
Okay, sir.
Okay, we'll meet next week. Next week, I think we plan to start at our usual time, 8 o'clock. I'll let you know if there's any change. But if by any chance, would you like to have at 7 or 8 for remaining weeks?
7 is also good, no, sir?
7 is good, no? You save some time. Okay. So shall we start at 7 then, next week also?
Yes, sir.
No problem, sir.
Great. Okay. Have a good day and stay safe. We'll meet
Sir,
next
you
week.
too. Right, thank you.